Welcome to Master Wealth, your go-to source for financial expertise. Whether you're looking to understand the impact of rising rates, government expenditures, or Federal Reserve policies, you're in the right place. In this video, we're going to discuss the implications of these financial dynamics. Subscribe and hit the notification bell to stay informed, and let's master wealth together. The stock market has seen a challenging September, with the S&P 500 down approximately 5% since the month's outset. During this period, the Dow Jones has lost nearly 3%, while the Nasdaq has shed around 7% of its highs. The stock market is currently under negative pressure due to many factors happening all at once. Firstly, the rise in oil prices has played a role. Secondly, there are concerns about the state of the treasury market. Lastly, we can attribute some of these difficulties to what we'll term as central forces encompassing government policies and the actions of the Federal Reserve Bank. Throughout 2020 and 2021, and to some extent in 2022, the Federal Reserve Bank significantly bolstered the stock market. Conversely, the recent uptick in interest rates has slowed down economic expansion. The Federal Reserve Bank publicly announced its decision not to raise interest rates in September during a meeting held about a week ago. However, they issued a warning that another interest rate hike might be on the horizon in 2023. This news was accompanied by the statement that interest rates are expected to remain elevated for an extended period, possibly until 2026, leading to expressed concerns. The potential consequences of this development are where the real significance lies. Rising interest rates have the potential to dampen activity in various markets, including real estate, automobile sales, and overall consumer spending due to the increased cost of money, which is a challenge that consumers face, which includes businesses and households. While there was optimism that interest rates would begin to decline in 2023, it now appears that the current period of rising rates may persist longer than initially anticipated. As we move forward, new concerns are emerging regarding the state of the economy, as we've highlighted before. Additionally, the price of a barrel of oil has recently exceeded $90, marking a significant increase over the past few months. This surge is a result of OPEC Plus countries such as Saudi Arabia and Russia reducing oil production to boost prices. This not only affects gasoline prices, but also impacts the costs of various other goods and services, despite the United States' continued dependence on imported oil. This is particularly important to consider in light of the ongoing inflation, with the recent data from the White House attributing part of this inflation to the rise in gasoline prices. If indeed the escalating cost of gasoline is driving up inflation, and if this trend of rising oil prices persists, it raises questions about the future trajectory of inflation. This situation is further entwined with the Federal Reserve Bank's efforts to curb inflation by raising interest rates. This complexity creates a scenario where heightened gasoline prices could potentially exacerbate inflation, possibly leading to higher interest rates, which in turn could pose additional challenges for the stock market, which is already grappling with its difficulties from previous rate hikes. This dilemma is currently occupying the thoughts of investors and traders, adding to the downward pressure on the stock market. This brings us to the subject of treasuries, a topic that has been on nearly every investor's mind as of late due to current rates. Regarding treasuries, they offer investors an alternative option for allocating their capital. Treasury securities are considered low-risk investments since they effectively involve lending money to the government. Investors face a crucial decision when it comes to capital allocation: where to invest it. Options such as the stock market, real estate, high-yield savings accounts, and treasuries are all on the table. What we've observed is a steady increase in yields on Treasury bonds, attributed to factors like the Federal Reserve Bank's interest rate initiatives, quantitative tightening, and investor concerns about a potential economic slowdown. The yield on the 10-year Treasury note recently surpassed 4.6%, a level not seen in approximately 15 years. Similarly, the yield on the 2-year Treasury note is now above 5%, a range not witnessed since 2006 to 2007. For investors, particularly those holding cash, the decision of where to park their money becomes pivotal. The prospect of a guaranteed return of 4.6% over several years might make treasuries more appealing than the stock market due to their low-risk profile. We are not advocating for treasuries, but rather, we are outlining the factors to consider and the questions that may arise for investors. As a natural outcome of rising treasury yields, an increasing number of institutional and individual investors are turning to these potentially safer assets. This shift of capital away from the stock market could lead to a decrease in the number of buyers participating in the stock market, given the fundamental relationship between supply and demand in determining stock prices. A reduced number of buyers can be expected to exert downward pressure on stock prices. This discussion wasn't relevant a few years ago when bond yields were exceptionally low. Back then, the choice between investing in stocks or alternative asset classes wasn't as challenging as it is today, with the previous bond yields almost negligible. We are now witnessing some respectable yields in treasuries, and money is beginning to flow in that direction. Consequently, we can anticipate a reduction in the amount of capital being allocated to stocks. Additionally, we must factor in the ongoing developments involving the United States government and, of course, the Federal Reserve Bank. While delving into the possibility of a federal government shutdown in this video might make it unnecessarily lengthy, it's worth noting that concerns about a potential government shutdown have re-emerged. What does this signify? Essentially, it suggests that certain government operations might face financial constraints in the future. Throughout history, such crises have typically been resolved by raising the debt ceiling and, in some instances, resorting to additional money printing. However, the significance of this topic is underscored by Fitch having already downgraded the credit rating of the United States government once in 2023. Recent statements from other rating agencies, such as Moody's, indicate their concerns that a government shutdown could further negatively impact the country's credit rating. Why is this of concern? Well, a substantial portion of the United States debt is held by a diverse group of investors, including private individuals, domestic institutions, and foreign governments. Consequently, a credit downgrade for the United States government would prompt individuals, institutions, and other countries to demand higher returns to compensate for the increased risk associated with investing in U.S. government debt, given the heightened possibility of default. Investments with higher risk require higher rates of return compared to those with lower risk. This brings us back to treasury yields, which become more attractive as they rise, offering a more defensible investment and a higher rate of return. However, there is a trade-off, as this would mean the government would have to allocate more funds towards interest payments due to their higher yields on treasury bonds. The sector of the United States government's expenses currently experiencing the most rapid expansion isn't Medicare or the military, but rather interest expenses. This is primarily attributed to two factors: the rapid growth of the national debt and the increasing interest rates on that debt. Both factors contribute to an overall increase in the cost of servicing the debt, resulting in a dual effect. First, the federal government's debt burden grows, and second, the cost of servicing that debt also rises. The rise in treasury rates may offer advantages to individuals who own these investments, but it also translates into a higher allocation of government revenue towards servicing debt and paying interest. While this may be beneficial for yield-holding individuals, it may not bode well for the government. This unfolds during a period in which an economic slowdown could potentially lead to reduced tax revenue for the government. As individuals earn less, businesses see diminished profits, and jobs are lost. Tax income tends to decline during economic downturns. Similarly, businesses reporting lower profits contribute to a reduced amount of tax revenue collected through corporate taxes. This particular dynamic underscores the urgency of the situation. Furthermore, there is the Federal Reserve Bank. As previously mentioned in the introduction of this video, there's a considerable amount of uncertainty surrounding the Federal Reserve Bank's strategy for determining interest rates. On one hand, they have consistently expressed their intent to curb high and challenging to manage inflation. On the other hand, they recognize that raising interest rates could result in repercussions such as a sluggish economy, the potential for a recession, and an increase in the number of people seeking employment. Consequently, they are striving to find the appropriate approach to address interest rates while managing this delicate balance. In their most recent meeting, they left the financial markets guessing, suggesting that interest rates would continue to remain elevated for an extended period, with the possibility of further increases. So, what does this information signify for you in a broader context? As we've emphasized on this channel, it underscores the significance of financial education and preparedness. The year 2023 is not the time for extravagant purchases like buying a new car. Instead, it presents an opportunity to focus on financial literacy, establish a financial safety net, and cultivate the knowledge and skills necessary to seize opportunities when they arise, all to help you build wealth. Given the intricate nature of the financial world, being financially informed and well-prepared is essential if you aim to create opportunities for yourself. Moreover, it's crucial to note that the repayment of student loans, encompassing both principal and interest, is set to recommence in a matter of days. This pertains to both the interest and principal components of the loans. If you have student loans, it is in your best interest to evaluate your situation promptly, as interest accrues daily, and prudent debt management can yield significant financial savings over the course of your repayment. Thank you for joining us on Master Wealth. If you found our financial insights valuable and want to stay up to date with the latest strategies for growing and managing your wealth, we invite you to subscribe to our channel. Don't forget to hit that notification bell so you never miss an important update or analysis. Your financial journey is important to us, and we're here to help you navigate it successfully. Subscribe, turn on notifications, and join us in mastering wealth for a prosperous future.